At Passive Pockets, we're always looking for ways to bring you the content and insights you need to succeed in your investing journey. That's why we've created a quick survey, your chance to tell us what you love, what you want more of, and how we can make this show even better. It only takes a few minutes, and your input means the world to us. If you take the survey now, you'll even get Steve Sue's amazing ebook, Avoiding Rookie Passive Investing Mistakes, completely free. Click the link in the description or head to www.passivepockets.com/survey. That's passivepockets.com/survey to take the survey now. Thanks for helping us make Passive Pockets your go-to source for passive real estate investing. Is 2025 the year multifamily investors see improved investment opportunities, or will quality deals prove to continue to be difficult to find? As market dynamics shift, short-term loan maturities create both tension and promise. Getting ahead of the curve has never been more critical. Hello, passive investors. Welcome to Passive Pockets, the passive real estate investing show. I'm your host, Jim Pfeifer. Today, we're exploring what's next for multifamily investing in 2025 with our guest, Brian Burke, an industry veteran who's managed over $500 million in real estate assets and authored the acclaimed book, The Hands-Off Investor. Brian will guide us through emerging market trends, realistic return expectations, and the crucial factors passive investors should consider when looking to invest in multifamily in 2025. Let's dive in with Brian Burke. Brian, thank you for being on the show again. We appreciate you.
Jim, it's always a pleasure to be here.
All right, we're going to jump right into it. And this episode is going to focus on multifamily, your expertise. So give us the basic overview of investing in multifamily assets. Why typically is it attractive? What are some unique challenges? And how did you decide to invest in multifamily?
Well, I think multifamily is attractive to a lot of people because it's familiar, right? It's a residential real estate asset class. And everyone's familiar with that because you live in residential property, whether you live in an apartment or you live in a house. So I think it's really familiar to people. And as a result of that, they tend to gravitate towards investing what they're familiar with. But there's also an underlying fundamental thesis for investing in multifamily and in residential in general. And that is that there's a lot of it out there to invest in. It's one of the life's most necessary elements, right? Food, water, shelter. I mean, it's in that class of necessities. And I think that, if you look at the historical performance of multifamily, it's done quite well relative to other investment alternatives. And I think that attracts a lot of people to the space.
And what are some of the unique challenges? Not necessarily, we're going to talk about the current challenges, but generally, what are some challenges to this asset class that may or may not be found in others?
Well, certainly, your three T's, your tenants, toilets, and trash, the typical landlording issues that you would find in owning a single family rental home or a small duplex. Those are present in every residential asset, whether it's 100 units, 1,000 units, or 1 unit. It's just that it multiplies. So, you have management challenges. I think one of the biggest challenges in the large multifamily space is just staffing. Finding really good people to work at the property. One thing that's different about large multifamily assets from, say, small residential assets is you have a staff that's dedicated to to real estate, to the property itself. And that means that you'll have a manager that works in the office, in the leasing office. You'll have a leasing agent. You'll have an assistant manager. You'll have a lead maintenance role and maintenance technicians and porters, and janitors, all kinds of different employment classifications in this space. And finding really good people is a challenge, just as it is in any business. And I think it's probably one of the greatest challenges in owning multifamily assets. And it's also one of the most important challenges because the wrong staff will really give you a lot of headwinds and crosswinds to your investment performance, but the right staff can make a real difference in the outcomes. So that to me is the biggest one. Of course, there's other challenges, things like expense growth, insurability, just your regular typical landlording things like fires and floods and, that kind of stuff. So, we're talking about now one of our mottos in asset management these days is what we call fire, flood, and blood, right? And these are your life safety issues. These are the things you really have to take care of at the property. Even when times are tough and income is thin, you have to take care of fire, flood, and blood, and that's going to cost you money. And so those are just a variety of different things that you'll find in the challenges of asset management. People think that multifamily investing is buying, but that's just a very small piece of it. Asset management is really where the rubber meets the road.
Right. And buying is something you haven't done in quite a while, and we'll get into that. But, you still have your finger on the pulse of the market. So what changes, if any, have you seen in the multifamily market over the past year or so that give you reason for optimism or reason for continued pessimism? We'll take either or both.
You're no stranger to the fact I've had a little bit of pessimism in the market. I think I've come on this podcast and the Bigger Pockets podcast and described the multifamily market as a traffic collision where in the middle of the intersection, interest rates, cap rates, expense growth, and rent growth all collided in the middle of the intersection at the same time and left a big mess to clean up. And that's what we've seen over like the past 3 years. And things are starting to change. I mean, the market will bottom out. One of the first things that has to happen for values to begin increasing is for them to stop decreasing. One of the first things that needs to happen before rents increase is for them to stop decreasing. And we're starting to see that happen lately. And that's giving some optimism that the bottom is a little bit closer now than it was perhaps 3 years ago when the switch was flipped and the market changed on us.
And do you see a lot of investor capital on the sidelines just waiting? I mean, we are still seeing deals. If you're an LP, there are deals, but there aren't a whole lot of multifamily deals. It's either other asset classes or just a few specialty type deals like, big tax abatements or things like that. So is there capital on the side, and are they just waiting to jump in?
Well, I think there is some capital on the side, but I don't think that it's as much as people think. A lot of investors are hesitant to invest in this space right now. A lot of passive investors are hesitant to make investments in syndications and in multifamily because, scars and wounds heal slowly. And there's a lot of investors who have taken a few licks over the last couple of years. And as a result of that, some of them are less than excited about investing in multifamily. Some of them are just like swearing it off, like, I'm not going to do this anymore. But there remains to be believers and those who say that, this is a resilient asset class with strong underlying fundamentals. And there's a case to be made for making investments in this space. And there's certainly a case to be made at doing it when the market is what we would call maybe in a trough. So I think that there is some money out there, and I think that really smart money and some contrarian money is going to start making inroads here, and we're going to start to see some deal velocity picking up at some point in the not too distant future.
When we look at things that have caused some trouble, like occupancy and rent growth, and there's been a lot of units delivered in some of the hot markets. So can you talk about how that has kind of gone through? Are we at the end of that, the middle, the beginning?
We'd like to think we're at the end of it, but we're in the middle of it, in my opinion. So multifamily construction really got ramped up in kind of the early 2020s. So call it 2021, 22, 23. The market was out of control. I mean, there was really no other way to put it, especially in 2021 and early 22. There was a lot of optimism. In fact, what I described as irrational euphoria in the market, and that got developers stoked up. And developers wanted to build, and investors wanted to feed those projects and build. And boy, have they. I mean, deliveries in multifamily in some markets, especially in the southern half of the U.S., have really accelerated in response to that market dynamic that's no longer here, by the way. But yet it takes a long time to go from concept to reality in the development world. So that means that everybody who got started and got past the point of no return in 2020, 21, they had to finish those projects out and get them built, and they've been delivering. What's also happened is that project delays, permitting timelines, materials deliveries, these kinds of things have stretched out the construction timeline to a great degree. And as a result, these projects that people thought would have been finished by mid 24 are probably stretching out into mid 25. So I see a little bit of, kind of these legacy projects that are going to create a hangover in 25. I think a lot of people didn't expect that, but I think that's going to play a role in this market for a few more months and cause the so-called recovery to be delayed a little bit. Somebody made up the saying, and I think it was Hopeful Owners, made up the saying, survive till 25, right? And the theory was, interest rates are going to come down and save us. If we can just get until 25, we're going to be good. I never really believed that, so I came up with my own. And so mine are, it'll be fixed in 26, we'll be in investor heaven in 27, and if you wait till 28, you'll be too late. I think those are kind of what I'm looking at as we see how the market's going to trough out and begin its recovery.
Well, I like those. At least you're putting dates on it, and it's not just sometime way, way in the future. So that gives me a little bit of hope. Some of the stuff that got us into trouble, and we're talking less about development and more about, what typical LPs invested in, which were, value add or heavier light value add, some kind of, multifamily where they're buying an older property or a newer property, doing something to it, and then, renting it out. And some of the things that got people in trouble were the interest rates, right? The variable interest rates. We've talked about that with you before. There were some supply chain issues from COVID, which, still are left over. Costs, inflation, building costs go up, insurance increased. So can you touch on those lingering concerns that I just mentioned? Are those things all, you did a little bit, but are those all still there and all still problems, or are they kind of winding down?
Well, they're still here and they're here to stay. And this is what I think a lot of people haven't come to terms with, is that these higher insurance costs aren't going away. Maybe some of the so-called, COVID supply chain problems are starting to mitigate now, where it doesn't take you a year to get a set of windows or a year and a half to get an electrical panel. I mean, those were real issues over the last few years that are starting to normalize to a degree. But there's some lingering issues that are creating challenges in this market. And one of those is the overhang of newer product and kind of a little bit of a calming of the demographic shifts that we saw post-COVID are creating a situation where tenants really don't want to pay these huge rent premiums for these so-called value-added renovated units. And it used to be that, you could put $6,000 or $8,000, $9,000 into a unit, raise the rent $200, $300, $400 to the next guy, and they were happy to pay it because they're getting this really nice renovated apartment unit. Well, now they can say, this is great. It's nice that you have this unit, but I can go, a quarter mile down the road and rent a brand new unit that's never even been lived in. And they're going to offer me, 3 weeks free rent. And, the rent isn't much more than your rent. So, your pricing power to get the returns on some of those renovated units is a bit challenging in this market. So that also hasn't gone away. So a lot of the things that have been plaguing us, while they're getting better, are not going away, and some of them will not go away. And as owners and as prospective buyers and as passive investors, we need to adjust to this new reality of where costs are, where interest rates are going to be, where values are going, and make sure that we're investing to reality, not investing to hope, prayer, and the belief that things are going to return to what they were 4 or 5 years ago.
4 or 5 years ago, and now even, it's all the same states, right? It's the Smile States, the Southeast, the Southwest. And, recently I saw a multifamily deal in, of all places, New York State, right? Or New York City even. They had like a specific thing. I've seen some in the Midwest. So could it be that some of the issues that we're having in the states that we've been thinking, hey, these are the where everybody's moving, now are there opportunities in the places where people have left? Could that be a change? That
would have been a play maybe 2 or 3 years ago if you could have got in at a really good basis. I was on a podcast, I think about 2 years ago, and somebody asked me, if you were to invest today, where would you see the most rent growth? And this guy was in like Cincinnati or something like that. And I said, this may surprise you, but I think it's going to be right in your own backyard. And that actually turned out to be true. The Midwest has been the rent growth leader nationally for the last couple of years. And that's because their rent never really went up. And so, now you get into this market and their rent growth is, while moderate, looks good by comparison when you compare it to other markets. flip the other side of the coin, and you look at a market like, Phoenix or Vegas or Atlanta and Dallas and so on, where the rents were up significantly post-COVID. And now what we're seeing is some negative year over year rent growth because things kind of have to normalize. It went up too far, too fast, and has to get back to something that makes a little bit of sense. So you've got this loss of this rent growth that's occurring in those states. So one could argue like, okay, let's invest in the Midwest. And while there may be some, basis to that thesis, I still subscribe to the theory that I want to invest in markets where people are moving to and avoid markets where people are moving from. And ultimately, this is a tortoise and the hare scenario where these Midwestern markets may outrun you in 24 and 25, but come 26, 27, 28, the pendulum is going to swing in the other direction. So if you can find something in, the so-called smile states at a really good basis, today, now, or soon, I think that you're going to have a better outcome 3, 5, or 7 years from now than if you had invested the same dollars in a market that perhaps today looks a little stronger.
And can you talk about, there's people, and everyone has a different definition, I'm sure, A class, B class, C class properties. Can you kind of talk to us about what those mean, and then are there differences, headwinds, tailwinds that you see in the coming years for each one of those gradients, if that makes sense?
Yeah, well, your A-class stuff is your newer product or your nicer product or your better neighborhoods. These are the places where, everybody would aspire to live, right? And as a passive investor, you have some means, you have some, resources, and you could live wherever you want. This would be a place you would choose. Class B is a place where, it's nice, good workforce housing. It's probably a place where you've lived in the past or would be willing to live. Maybe a little bit older product, maybe not, the newest up and comer. Your Class C stuff is the place where if you can't live in A or B, you'll live in C. And it's not really where you want to be, but it's where you are because that's what you can afford to do. And then you got your, Class D and F, which is where you hope to survive if you make it out. So those are properties that are very challenging and difficult to own. So, in terms of challenges, Class A has a challenge that it has competition, right? You can build another Class A property next door and that can create competition. On the other hand, it has competition in a good way too, because everybody really aspires to live there. So, if people can live there, they will. And so there's always demand for Class A. And it's a really good space. It's considered to be one of the safer asset classes in the multifamily space, and that's why institutional investors gravitate towards it. Class B is your kind of in-betweener. It's a really good investment space. You can capture folks who are coming out of Class A because they can't afford it, because they've had some hit to their income or whatever. Maybe they have to downscale. You catch those, and you catch the people that are moving up from C because they can afford to do better now. And so you kind of got demand coming from both directions in Class B. It's a really good space. Class C is the product that you really can't even give away right now. They're really difficult to own because you have collection challenges, resident quality challenges, crime can be a challenge, residents not taking care of the property, that can be a challenge, all sorts of stuff, slip and fall claims, maintenance issues that run the gamut from minor to very complicated to solve. People oftentimes say that they really like to invest in Class C because the so-called cash flow is better, but then they realize how much it costs to maintain the asset, and the reality doesn't quite fit the narrative, and they become very difficult to own and not very good results. That's why right now it's very difficult to get Class C over the finish line because investors don't want to invest in it. Equity partners are avoiding it like the plague. So if you're well capitalized, maybe there's some opportunistic plays you could come in and swoop up something really cheap. But just know you're going to have your work cut out for you.
All right, so let's transition a little bit and talk about, everyone's favorite topic is the debt. We always talk about we're just about to where people are going to start foreclosing. Banks are going to start foreclosing because people can't push it down, their rate caps, or can't push the interest rate issue down any farther, down in time. So can you talk about where you're seeing that? How are the maturities coming? Is there going to be an issue, or are we kind of past it or still in the middle of it?
I think we're in the early stages of it, actually. I think, the biggest problem that I saw in the financing space was that in 20, 21, and 22, and even into 23 a little bit, buyers were relying very heavily on short-term bridge debt. Now, you and I have had this discussion before, Jim, and short-term bridge debt was designed for the purpose of taking an underperforming property that didn't qualify for better financing and giving buyers a way to acquire the asset with enough time to improve its operations to the point where the asset would qualify for permanent financing. But what's happened is during this window of time, 20, 21, 22, these buyers were repurposing the bridge loan to use them instead for a crutch to make up for their inability to raise capital. Maybe they didn't have enough investors, so they could get a bridge loan that had higher loan to value, and that meant raising less equity. Or maybe it was a case where the sponsor themselves, being brand new to the business, didn't qualify for agency financing, so they took out bridge debt because bridge would loan to them. And, that's created this real issue where now you've got all these 3-year loans that were originated 3 years ago or maybe 4 years ago that are coming due. Those maturity dates are approaching, and the owners have no way to refinance into permanent debt, either because the property never became performing as they had expected. Rent growth didn't materialize as was projected. The sponsor's experience didn't increase because this might have been the only property they ever bought, never bought another one and got more experience. Or the interest rate scenario, which is kind of the big one, where rates are higher and you can't refinance into higher rates because the properties are coverage constrained, meaning they don't produce enough income to service the debt, even if it was a better interest rate, which a lot of them are not these days. And then you also still have this other kind of overhanging issue, which is the property values have fallen. And, the LTVs are way too high. In some cases, the properties are worth less than the loan amount. So it's made a scenario where, if the biggest risk in this business is if a loan maturity occurs during a down cycle. And that's what we're seeing right now. All these loans are maturing during this down cycle, and the owners really have no way out. So, to begin with, lenders were extending the maturities and giving the owners more time and saying okay, we'll give you another year, give us $1 million principal reduction, and we'll give you another year. Or, some other kind of arrangement where there's a little bit of a quid pro quo, you scratch my back, we'll scratch yours. That's all well and good, but the statistics aren't bearing out any fruit. There was an article I read recently that says 90% of the loan modifications that have been issued are redefaulting. In other words, they gave them another year, and 90% of the time they're coming up on the new extended maturity date and still have no solution. And so that's going to create a bit of an issue that we haven't really seen yet, where there was this whole extend and pretend theory. And this was part of the survive till 25 saying was, okay, if we can get another year until 25 and we can survive, then we can refinance in 25. But the problems that were underlying the asset class aren't going to be fixed by 25. So they're still going to have the same problem in 25 that they had in 24 or 23 or 22. And I can guarantee you that the lenders that made these extensions and provided concessions to the borrowers did not do that because they were looking out for the borrower's investors or the borrower. They did it because they were looking out for themselves. And that means that as soon as the market starts to come around, these lenders are going to become a little less patient. And you're going to see them begin to go into receivership, foreclosure, forced sales, that kind of thing. And we haven't even really seen that happen much lately. It's happened a little bit, but it hasn't happened much. And that's why I think we're still in the very early stages of that so-called hangover.
So that's the current deals. Now for new deals, which again, there aren't a whole lot out there, but is debt being structured differently? Are they doing more fixed rate or adjustable rate agency debt, which has a longer term? What are you seeing out there for current debt situations?
Well, certainly there's those who don't learn lessons very well and are still using the same old debt strategy, which there will always be those, right? But yes, I think that strategies have changed and they haven't changed. I would still be a really big fan of using floating rate long-term debt. There is such a thing. You can get debt for 10 years that has a floating rate. The advantage is you don't have yield maintenance, which is a huge prepayment penalty. The disadvantage is you have interest rate risk. Now, that interest rate risk might actually be desirable in a market if you think interest rates are topping and that rates are going to fall. Your rate would actually fall if rates fall. And so that could be a very good financing package, but it's very difficult to make those work right now because the yield curve is inverted and the short-term interest rates have been higher than long-term interest rates, meaning that there's really no way to get a deal to cash flow if your loan is at 8% or 8.5%. Fixed rate debt is available out there right now with buy downs at about 6%. So maybe 6.5. So it's making the floating option very difficult to work. So what I'm seeing mostly now is people are doing 5-year fixed rate debt a lot with buy downs where they're getting the interest rates kind of in that upper 5s, low 6 range with 5-year maturity, oftentimes with step down prepayment penalties like a 3-2-1 type of prepayment penalty versus just full on straight yield maintenance.
I want to pivot again and talk a little bit about limited partner investors and kind of what realistic return expectations do you think they should have if they do invest in deals in 2025? I mean, they're certainly going to be lower than if they had invested in 2020 or 2021 when things were, really hot, at least the pro formas. So where do you see kind of the expectations for limited partners, or where should they be?
Well, we should certainly think that the actual results will be better because their pro formas may have looked really good, but what if the actual results turned out to be not so good, right? But now I would think you would see pro formas that may not be much different than they were before, maybe slightly less, but maybe even not much different. But I think you're going to see actual performance be closer to the pro forma performance or perhaps even exceed it. I remember back in 2009 when we were pitching investments back then when it was really tough. I mean, people would tell me they won't even get out of bed for anything that doesn't start with a 2. I mean, if it wasn't 20% or higher, they weren't even going to waste their time. Come, 2019, it was like, 14, 15, 16 was really attractive to people. 2023, it was all over the board, but none of it was even true. I mean, every projection was just, pie in the sky. I think that you should see actual performance, on well-located and smartly purchased assets, kind of in that, low double-digit to low to mid-teens range on an IRR basis. But the other thing is you really want to see some cash-on-cash return. And this is something that I found interesting in 21, 22, 23, was during that period, even pro formas weren't projecting a lot of cash-on-cash return, 1-2%. That maybe would go to 4 or 5 or 6 that never came. But now I think you really need to see the ability to beat money market accounts. I mean, I'm a passive investor too. And why would I take money out of my 4.5% money market account to invest in a multifamily deal that has a 2% cash on cash return? I've got to beat that money market account, I think. And furthermore, that needs to come from the operations of the property. It can't be where you're raising an extra $200,000 to give me that money back as phantom cash flow. The property itself actually needs to perform above money market rates on a cash-on-cash basis. I think that's what investors should be expecting. And at least that gives you a floor. If you can see that there's actual cash coming in, you're getting that. The appreciation then is gravy. And now, if we believe in the market, we would believe, now this is where there's a bit of a disconnect. It's going to be very hard to forecast this. But if we believe in the market, we could see a situation where the actual performance is going to be quite good. Because when the market does quote unquote come back, and we start to see the things normalizing and, cap rates level out or maybe even compress slightly, rent growth comes back, there's high demand for units, there's low construction. When we start to see that again, values are going to increase. And at basis that you can find these days, which is quite low compared to where it was 3 or 4 years ago, I think actual investment performance can be quite good, but it's very difficult to forecast it that way, if you know what I mean.
Yeah, no, that makes sense. So one other question on the buyers and sellers, right? The prices have been apart for a while. So when do you think that will kind of fix itself and get closer? I know you said you promised me everything will be fixed in 26, I think it was, and I'll be in investor heaven in 27. So are we going to wait that long until, sellers and buyers meet up on price?
I think so. I think 25 is going to be the year where everybody has to start reconciling their beliefs. Sellers are going to eventually get pressured into coming to grips with where operations truly are these days. I mean, you can't sell on the hope that insurance rates are going to come down and interest rates are going to come down and payroll is going to decline. I mean, none of those things are going to happen. Let's lock in the costs where they are and assume that that's where the costs are going to be, and now make the property perform at or above money market rates on a cash flow basis. When you do that math, you're going to find that valuation has to compress. And 2 or 3 years ago, it was easy for a seller to go, you know what? I'm not selling at that price because, I'm 95% occupied and, I'm getting cash flow and at least breaking even. So I'll just wait it out. And that's fine for those owners that have that kind of time. But if every, 8 months they're re-engaging in negotiations with their lender for another extension, they're going to find themselves pressured into the position where they're going to have to say, you know what, enough is enough. We have to sell at today's reality, and this Grand Canyon gap of buyer and seller disparity is going to have to start to close. We're beginning to see it get a little bit closer. 25, I believe, is going to be the transition year. I think this is going to be the year where buyers and sellers are both going to start to get on the same page. Buyers have been a problem too. I'm one of them. I have been one of the biggest problems in this business where I'm like, send me a deal to look at. I can't hit the delete key fast enough because I don't care about your deal. So buyers have been guilty of this too. Buyers are going to have to realize, like, okay, the sky isn't falling. Interest rates are starting to become at least, I don't know if predictable is the word, but at least not as unpredictable as they were. The other costs, we can kind of get a grip on where they are now. They're not running out of control. Rent growth, we're getting an idea of where that is, and it's starting to make a comeback. Construction is starting to decline. So as buyers begin to realize that the sky isn't falling as much anymore, and you're not necessarily catching a falling knife, you can get back on, in the playing field. Sellers, when they start realizing that, they got to get real, this price disparity is going to begin to work itself out. And I think that's going to take place over the next year. But, this is a slow game, Jim. I mean, there's no rush to say that I've got to deploy all this capital in X number of days. I mean, we live a relatively long time. It's okay for us to say, I'll invest a little this year, a little next year, a little bit more the year after that. There's no reason you have to go in all at once. There's time to let this play out.
That's the real question, right? We've been building up to this. And, the real question that everyone's listening wants to know, you haven't bought a property in several years. So is 2025 the year that Brian Burke buys his next multifamily, or is it going to be beyond that?
This may come as a surprise to you, but my answer is I hope so. Anybody that hasn't heard me on this podcast before and doesn't know the story, in 21 and early 22, I aggressively started selling my portfolio and sold 3/4 of my stuff right before the market collapsed. And I had one deal in contract when the market did collapse. So I can tell you almost to the day when the switch was flipped. So I still have about 1,000 units in my portfolio, but I have a lot less than I did have, and I haven't bought a single thing since. So for me to say that 25 might be my year is a big statement, because all I have said the last few years is I'm not interested. I think if I can find a property at a really good basis that's a high quality asset in a good market that I can cash flow at or above what a money market would produce right out of the gate, with prospects for a bright future where there's going to be some rent growth, price growth, and all those things, then I think that I would probably hit the green button on such a deal. Now, we'll just have to see if that comes along. It may or may not, but if it does, I think I'm here for it. I think we're close enough to the bottom now, or if I'm not hitting it exactly, I think that there's reasons to be optimistic about what's going to happen in 26, 27, 28, and 29, where you can get in low and sell high. That is the idea, if I recall, Jim.
I think it is. It's been a while, but I think it is. And just for the listeners here, you heard it here first. Definitely Brian Burke might possibly maybe think about buying a property in 2025. That's the message I got. Is that accurate?
Yeah, and you're right. You did hear it here first, because I have not said this to anyone until this very moment. So I think you may have heard it here first.
Well, that's fantastic. Brian, we cannot appreciate you more than we do. You give us the hard information, even if we don't want to hear it. But we always do. So thank you so much for being on the show. We appreciate you being here with us.
It's always a blast, Jim. I'm happy to be here anytime you want me to come back.
And that wraps up our deep dive into what's on the horizon for multifamily investing in 2025. A big thank you to Brian Burke for sharing his expertise, offering insights into the market's potential opportunities and ongoing challenges, and what passive investors should realistically expect in terms of returns and strategies. Remember, staying ahead of the curve requires careful consideration of debt structures, asset class performance, and alignment with sponsors who have a proven track record and a plan for navigating uncertain waters. If you've enjoyed this episode, don't forget to like, subscribe, and leave a comment on your own multifamily outlook or questions you'd like answered. And don't forget, please take our survey linked in the description below or at www.passivepockets.com/survey. For more tools, resources, and a 7-day free trial to our community of like-minded passive investors, visit passivepockets.com. Thanks for tuning in, and as always, happy investing.